I'm Professor Intragroup. Let's look at Intergroup transactions. Here we are going to look at two types of transactions: depreciable non-current assets transactions and dividend transactions. That is, where the subsidiary pays dividends and the parent receives dividends. Under Intergroup depreciable non-current asset transactions, we get to look at a transaction that has taken place during this period of reporting for consolidation and a transaction that has occurred in a previous period, and we are preparing consolidated financial statements in the current period. So we're going to look at the depreciable non-current asset transaction that has taken place during this period. What we need to understand is when there is an asset being sold from parent to subsidiary or subsidiary to parent, the one that is selling in this instance is making a gain, and the one that is receiving the asset is recording that asset, which includes the gain. So there's overvaluation of the asset. Because it is a transaction within the group, that gain and the overvaluation is invalid. Gain is normally a credit. Normal side is credit. And for the asset, the normal side is debit. So we need to eliminate it. So in consolidation, in that consolidation entry, we debit gain and credit the gain on the unrealized portion or the overvaluation. You also need to acknowledge by crediting the asset, we decrease the asset value, which normally have a debit balance. So the carrying value of the asset decreases compared to the tax base. And the difference between the tax base and the carrying value is a deductible difference. And there's a tax component of that, which is a deferred tax asset, debit deferred tax asset, and credit income tax expense. Now the way to understand crediting income tax expense is we debit the gain on sale, or we decrease the profit. When we decrease the profit, we need to pay less income tax expense, and we need to account for less income tax expense, so we credit income tax expense. Another thing that we have to keep in mind is in any buy and sell transaction within the group, the ownership does not have any bearing, because we eliminate those transactions in full, that is in 100%, whether it is partly owned or fully owned, because this transaction occurs due to control, and the parent controls the subsidiary, and therefore we eliminate the transactions in full. But anything to do with ownership, like elimination of the investment, because it is to do with the ownership, we eliminate in proportion to the ownership. But when it comes to transactions, because the parent controls the subsidiary, we eliminate transactions in full. Whether the transaction took place from parent to subsidiary or to subsidiary to the parent does not matter. It's an intra-group transaction. So let's look at an example. Parent acquired 80% of shares in subsidiary, so the ownership doesn't matter. 2013 sold machinery for 20 million and pre-tax gain is 4 million in that. And at the date of sale, accumulated depreciation and the cost of the machinery is given as 9 and 25. Income tax rate for both parent and subsidiary are 30%. So the depreciation rate that is applied across the group is 10% per reporting period on a straight line basis. We require to show consolidation adjustments for the current period for the year in 30th June 2014, and the transaction took place on 1st of July 2013, which is the current period. So we can see in this diagram, there was asset cost 25, accumulated depreciation 9, carrying value of the asset is 16, was sold for 20. So the parent received the asset at 20 when and subsidiary makes a gain of 4. At the time of parent receiving the asset, accumulated depreciation is 0. At the time subsidiary is selling the asset, the cost was 25 and accumulated depreciation was 9. If you look at the general journal entries, when we sell the asset, subsidiary debit accumulated depreciation and credit machinery and receives cash of 20 and makes a gain of 4. Parent receive the asset and pay cash 20. When we combine the general journal entries of individual entities, cash cancels out and we come up with debit accumulated depreciation 9, credit machinery 5, credit gain on sale 4. So it is this summarized general journal entry we need to reverse in the consolidation, eliminating the consolidation by recording the opposite of debit to credit and vice versa. So first is to eliminate the general journal entry. So we debit gain, credit machinery cost, the difference, and credit accumulated depreciation. 4, 5, they are debits, and 9 are credit. If you look at the cost and accumulated depreciation, the difference 5 and 9, the difference is a net credit of 4. What it means is that we have not decreased the carrying value of the asset by 4. If we decrease the carrying value of the asset compared to the tax base, that difference 4 is a deductible difference for taxation purposes, and the deferred tax of that is 30%. So our second entry is debit deferred tax asset 30% of 4, 1.2, and credit income tax expense 1.2. Now that we have decreased the asset value, whereas the parent had an overvalued asset and kept depreciating the asset at that overvalued amount. But when it comes to the group, that asset is overvalued. Therefore, that depreciation recorded by the parent at a higher value, resulting in higher depreciation expense, has to be decreased. So the excess carrying value is 4 and 10% is the depreciation rate. And for 1 year, we need to decrease the depreciation expense 4 into 10%, and that's 0.4. Credit depreciation expense 0.4 and debit accumulated depreciation 0.4. Now we decrease the expenses, which means the profit increase. Because profit increase, we now need to increase the income tax expense. 0.4 into 30% is 0.12. And the deferred tax asset now decreases by 0.12 because the asset has been used for 1 year. And that deferred tax asset that we have generated at the beginning of the year based on the carrying value difference is 1.2. And from that, 0.12 is now decreased because over 10 years, that 1.2 will be decreased to 0. And deferred tax asset, which is a temporary asset, will then disappear. So I'm going to play this video for you. When I play this video, think about, is a gain on sale on non-current asset an entry on the debit side or credit side on the consolidation journal entry? The gain on sale of non-current asset. On to the next slide. So we're going to look at eliminating intergrouped transactions of depreciable non-current assets transacted during previous period. So we have a gain on sale and overvaluation of the non-current asset, but the gain on sale occurred in the previous period. Therefore, that gain on sale is included in the opening retained earnings. The gain overvaluation is an asset which is on the balance sheet, and that is still there on the asset. When it comes to consolidating the transaction, we need to debit opening retained earnings for the gain, for the unrealized gain, and we credit the non-current asset for the overvaluation. Because we are decreasing the carrying value of the asset compared to the taxpayer, that difference is a deductible difference, and the tax component of that is deferred tax asset. So we debit deferred tax asset and credit. We used to credit income tax expense, but that income tax expense, because the transaction took place in the previous period, that credit of income tax expenses in the previous period. Therefore, we credit opening retained earnings when we do the consolidation entry in the current period. So let's look at an example. On 1st of July 2012, parent acquired 80% of subsidiary, so that ownership doesn't matter because this is Intergroup trading transaction. And 1st of July 2012, sold an asset, which sold an asset for 20 million, had on a markup and so forth. And the cost of the machinery was 23 million, accumulated depreciation was 7 million at the date of sale. Income tax rate for both entities is 30%, and the depreciation rate is 10% per reporting period on straight line basis. And we need to record the journal entries at 30th of June 2014. The transaction took place on 1st of July 2012. From there to 30th of June 2013 is 1 year, and from 1st of July 2013 to 30th June 2014 is the second year, but the second year is the current year, and the first year is the previous year, and where the transaction took place. So keeping in mind, again, the seller subsidiary entity made a profit of 4, and the carrying value at that time was 16 with the cost of 23 and accumulated depreciation of 7. Parent bought it at that time at $20, and accumulated depreciation when he bought was 0. Parent entry was debit machinery and credit cash, and for the subsidiary, received cash of 20, accumulated depreciation we need to reverse when you are selling, debit 7, and machinery credit 23 because we are selling it. Now the gain on sale is now relates to the previous year. We are in the current period, so we credit opening retained profits. When we combine the two journal entries, we come up with debit accumulated depreciation 7, credit machinery 3, and credit for the gain on sale of asset in previous year, credit opening retained profit 4. So this is the journal entry we need to reverse eliminate in consolidated financial statements. So we start with that. Debit opening retained profit 4, credit machinery costs, debit machinery costs 3, credit accumulated depreciation 7. 3 and 7, the difference is 4. We decrease the carrying value of the asset by 4 because of overvaluation. So the carrying value is less compared to the tax base, and that 4 becomes a deductible difference. 4 into 30% is deferred tax asset, debit deferred tax asset 1.2, 4 into 30%, and credit for the income tax expense, it is the transaction took place in the previous period, so we credit opening retained profits 1.2. Asset was received by the parent and its overvalued asset was depreciating at a higher value, and there's excess depreciation which we need to reverse, eliminate in the consolidation. So that excess depreciation on that excess carrying value that we decrease by 4 is on that for a year excess depreciation expense is 0.4. So we decrease depreciation expense by 0.4 credit, and that's for the current year. For the previous year, because transaction took place at the beginning of the previous year, credit opening retained profits for the depreciation expense relating to the previous year 0.4 credit, and we debit accumulated depreciation together 0.8. Now we decrease the expense, profit increase. Because profit increase, the income tax expense will increase 0.4 into 30%, 0.12. We debit 0.12. We're decreasing opening retained profits. So the income tax expense relating to the previous profits will also increase. We are increasing the profit because it's a credit, and therefore the income tax expense which we have to debit, but we debit to opening retained profit 0.4 into 30%, 0.12 opening retained profits. And 2 years of the asset use, the deferred tax asset decreases, and 2 years 0.4 into 30%, and that's 0.4 of 30%, and it's 2 lots there, and because 2 years, and that's 0.2. Current period, previous period, you can see the first transaction, debit profit on sale, debit asset cost difference, credit accumulated depreciation. The current period, previous period, debit opening retained profits, that's the difference, debit asset cost difference, and credit accumulated depreciation. The second transaction is the tax effect, current period, debit deferred tax asset, credit income tax expense. For the previous period, debit deferred tax asset for 2 years, 2 periods, credit opening retained profits because that income tax expense has become opening retained profits, and credit income tax expense for the current period. Third is eliminating excess depreciation, current period, credit depreciation expense, debit accumulated depreciation. For the previous period, debit accumulated depreciation for 2 years, and depreciation expense for the previous period has now become opening retained profits, credit opening retained profits, and credit depreciation expense. The tax effect of that is debit income tax expense and credit deferred tax asset in the current period, and for the previous period, debit opening retained profits and debit income tax expense, and debit income tax expense is we are now debiting for opening retained profits and debiting income tax expense and credit deferred tax asset. These 3 questions were raised. You may pause the video here and then move on. But I will move
Basics of how you do consolidation. In this video, I want to cover the basics of how you do consolidation worksheet entries when one of the companies has sold a depreciable asset to another company. This is somewhat similar to what we did in class where one company sold a piece of land to another company, but this gets a little more complicated because of the depreciation involved, that when one company sells to another company, typically changes the depreciation schedule, which then makes depreciation screwed up, and we have to figure out what the screw up is, go in and fix it. So let's look at the simple example I've set up. On the first day of 2011, parent sells a building to sub for $200,000. The building had an original cost of $150,000, and so far the parent has done $30,000 of depreciation as of January 1st. The parent was depreciating the building at $10,000 per year up to that point. So the new company, the sub, buys the building for $200,000. Because of that, it's going to do a higher depreciation rate. So for simplicity, let's assume it's doing $14,000 per year. So what would the parent be reporting from this sale? Did they have a gain or a loss on the sale? Well, recall from other accounting classes that to figure that out, you compare the selling price of the building of $200,000 to its book value. The book value is the original cost of $150,000 minus the $30,000 that's already been recovered. So $150,000 minus $30,000 means the book value is $120,000, They sold it for $200, so the parent would be reporting a gain of $80,000. So we show up to do the consolidation. Our worksheet entries will need to do three things. One, we will need to reverse that $80,000 gain that the parent is reporting, because that, from our viewpoint, was not a sale to an external party, so they cannot report the gain on a consolidated income statement. Number two, the sub is showing the building at $200,000, but on a consolidated balance sheet, we need to get that reset back to the original group's purchase price of $150,000. A second entry we'll use to fix the depreciation. The sub, from our viewpoint, is doing too much depreciation expense because they're doing $14,000 per year when we want it to only be $10,000 per year. When I was first learning this, I finally figured out that what would be very helpful to me is if I set up T accounts for all of this information rather than trying to hold it in my head. Okay, so here's a bunch of T accounts. I'm going to let the three at the top of the screen represent the parent's T accounts, and there I want to record how would things look if the parent had not sold the building to the sub. The bottom three will represent the subsidiary's accounting records as it currently shows the building that they've purchased. So if the parent had never sold the building, the top building account would have a debit balance of $150. Problem said that as of the first day of the year, they had done $30,000 of accumulated depreciation, and they do $10,000 a year depreciation expense. So at this point, this is the beginning of the year, this 30, and 10 is the current year. The parent is also at this point reporting a gain on the sale of $80,000. All right, but they did sell it. So the building, the sub thinks, and this is what they would be showing in their accounting records, they would show the building at $200. As of the first day of the year, they would not have done any depreciation yet, but during the year they would do $14,000. So when we show up to do the consolidation, we want to reset the T accounts so they reflect what the parent would be showing if they had never sold the building versus the bottom T accounts, which is what the sub is currently showing. So look at that. We're going to need to reduce the building account, so we're going to need a credit. We're going to increase accumulated depreciation from 0 to 30, and we need to reduce depreciation expense from 14 down to 10, and we need to get rid of that sale. So the first consolidation entry that the authors call TA will do that. The purpose of that one will be to deal with the gain, get the building account reset to its correct amount, fix accumulated depreciation as at the beginning of the year. I'm going to do a separate entry that the authors call ED for excess depreciation to deal with the fact that the sub is doing, from our standpoint, too much depreciation. One of the nice things about that second entry, ED, is that entry will be the same every year going forward for as long as they are depreciating this building. What is going to change, though, every year is that TA entry. So we need to talk about how the numbers and the accounts are going to change in the first year after the transfer. The best way to make sense of that is to go back to the T accounts. So let's think, how would things have changed 1 year later? If the parent had never sold the building, they would still show the building at $150,000, but they would have done another year's depreciation, so accumulated depreciation would have climbed from $30,000 up to $40,000. They would do another $10,000 depreciation expense that year. Would they still be showing this gain on sale? No. That would now be closed. The previous year they would have closed it to retained earnings. But again, we don't think that gain should have happened yet. So from our viewpoint now, retained earnings is overstated by 80 because of that gain. When we show up a year later, the sub would still be showing the building at $200,000. Now, though, accumulated depreciation would not be 0. They would be showing it at $14,000 because they were doing $14,000 in depreciation per year. their current year's depreciation would still be 14. But what would be the effect on their retained earnings? Right? They put 4,000 too much depreciation in. That would have been closed out to retained earnings. So the net effect on retained earnings, and this is the key, the net effect is it's overstated by 76. So we need to fix that. Let's pause and see what changed in the TA entry from the first year, which was the year of the intercompany sale, to the next year. Instead of debiting gain, I'm now debiting retained earnings, and the number is slightly different. The number changed from 80 to 76. That's a change of $4,000. That change exactly equals the amount of the ED entry. And again, it's not coincidence. Look back at the T accounts and you'll see the retained earnings is overstated by 80 for the gain, but then it came back a little bit because depreciation expense was overstated by 4. Expense and gains are opposites, so the net effect is retained earnings overstated by 76 as of the beginning of the year. The building credit did not change. It's always going to be 50 because we always need to reset the building from 200 back to 150. The accumulated depreciation number did change though, as that difference in depreciation is going to keep going year after year. We're going to have to take that into account. Notice it changed from 30 to 26, changed by exactly 4, which is the amount of over depreciation expense. So when we come back in the year 2013, it's going to change by another 4. It'll drop from 26 to 22. So back to my T accounts. Let's say another year goes by. How would these change? The building accounts don't change. What would change is accumulated depreciation. Instead of 40, the parent would have 50. Again, the top ones are if the parent had never sold the building. Accumulated depreciation would have grown to 50. But they did sell the building. The sub, how would that change? They would have done another year's depreciation. So this would change to be 28. 14 would be the current year's depreciation, so that's fine. But over here, what would have happened? Another 4,000 of too much expense, bringing the net now to 72. So retained earnings overstated by 72. So now I got to fix this. And there you have it. It would keep going on year after year. Try to work through this problem again on your own. Once you think you've got it mastered,
I'm going to now talk about eliminating intragroup transaction. And intergroup transaction, when we are eliminating intergroup transactions, is the dividend that we pay from subsidiary to the parent that we have to eliminate. So we debit dividend income from subsidiary and credit the dividend payment to the parent. So if we take transaction here, we eliminate dividend based on the parent's ownership, because the parent is going to receive dividends from the subsidiary based on the ownership. Even the subsidiary pays in full, not the full amount goes to the parent. So if you look at any dividend that's receivable and payable, receivable by the parent and payable by the subsidiary, has to be eliminated. Interim dividends are usually paid, and they're paid in the current period. Is a final dividend that's declared that is to be paid at end of the period. Any dividends that are to be paid are based on the ownership. So here's example on 1st of July 2012, parent acquires 70% of subsidiary for 40 million net $2 per issued share. Now the ownership matters here. On 1st of October 2013, the parent subsidiary entity declared 20 cents share of 4 million interim dividend and 1st of December 2013 paid in cash. That's the interim dividend. And 29th of June 2014, subsidiary declared 40 cents per share, 8 million dividends, which is final dividends from post-acquisition equity, that is the profit collected from after the acquisition period, after the acquisition to be paid on 1st of July, 1st of August 2014. So it's after the year end is going to be paid. Provide journal entries, consolidation entries at 30th of June 2014. So if you look at what has happened was interim dividend, 70% of that parent received it, and final dividend, 70% of that is declared and parent is yet to receive it, but parent has to account for it. So if you look at the parent and subsidiary, the general transaction, and for the interim dividend, cash was received 2.8, dividend revenue was recognized, and then for the final dividends, there's dividend receivable of 5.6 out of 70% of 8, and dividend revenue is 5.6. That's what the parent recorded. And for the subsidiary, it recorded cash of 4 and interim dividend of 4, although parent received only 2.8, and the final dividend payable was 8, and final dividend is 8, but it's only 80% of that goes to the parent. So if we combine the general journal entries, we have to ensure that uh, we only account for the ownership. So interim dividend is 2.8 and dividend revenue is 2.8. So for the final dividend, it is 5.6. That's 80% of 70% of 8. Final dividend debit, uh, final dividend and credit, dividend revenue 5.6. Because it was not received in cash, you have to debit dividend receivable 5.6 and credit dividend payable 5.6. So it is this journal entry we need to eliminate. So when we are eliminating, we debit dividend revenue 2.8, credit interim dividend 2.8, final dividend debit dividend revenue 5.6, and credit final dividend 5.6. And for the payables and receivables, debit dividend payable 5.6 and credit dividend receivable 5.6. Note that the remaining dividend, which is 30% of dividend, will go to non-controlling shareholders uh, in here, and those dividends will be dealt separately. So the summary of the entries are interim dividend, debit dividend revenue, and credit dividend paid, and for the final dividend, debit dividend revenue and credit dividend declared, and also debit dividend payable and credit dividend receivable.